Hi, a good way to gradually accumulate investment equity is by creating a portfolio management system. It can help you diversify your stocks and reduce investment risks. We use SlashTraders' official account as an example to share a few of our favorite portfolio management strategies to help you generate a consistent profit in the long run. If you enjoy my videos about investing in US stocks, please like and share my videos and subscribe to my channel. Thank you. We'll talk about 3 key points today. 1. What is portfolio management? 2. What is asset allocation? 3. What is rebalancing? Portfolio management is a system that combines multiple types of trading instruments or invests in many different sectors or industries at once. This reduces the risk exposure to any concentrated underlying. No matter which way the market goes, a diversified portfolio can reduce risks and become profitable in the long run. Looking at SlashTraders' official trading account, we have a portfolio of around $40,000 in net liquidity. 90% of our account's liquidity is used for long-term investments. When we find value stocks or high dividend yielding blue chip stocks, we will buy and hold them for a long time. Within the 40,000 net liquidity, we use around 16,000 buying power to trade options to take advantage of short-term market volatility. Depending on different technical analysis results, we trade short strangles in neutral trending stocks or sell credit spreads when we anticipate large volatility soon. You might be interested in knowing why we have a ratio of 1 to 2 in options trading versus stock investment. Options trading has much greater risks than stock investing, as options have a time limit to turn a profit when the contract expires, while losing stock investment can patiently wait for the stock price to rebound. So we limit the amount of options trading to reduce the risks of our portfolio, while using the stocks for long-term growth. Asset allocation is spreading the risk of the portfolio by splitting the investment capital across multiple different stocks. Even when one stock crashes, the whole portfolio shall not suffer a lot. Apart from buying value stocks with huge upside potential and high yield dividend stocks, our portfolio also invests in different sectors, industries, and countries. If any industry sector or a single country goes into recession, our overall portfolio shall remain profitable in the long run. Rebalancing is when we readjust the relative sizes of the stock positions after the stock price have changed. The act of rebalancing usually leads to selling high-value positions and buying low-value positions. The advantage of rebalancing is that it helps us make systematic decisions on buying low and selling high, thus reducing the emotional toll on trading. At the next rebalancing cycle, we can sell high market value positions and then buy low market value positions. The relative values of each position should reset to the original setup after rebalancing, so the portfolio will not lean heavily towards any single stock and diversify the risk. Now you know a few basic portfolio management strategies to help you diversify risks and systematically readjust your positions to gradually accumulate wealth.